Hi, I'm Jimmy. In this video, we're looking at some fears that many investors have. Fears like, what if the stock market crashes? Or what if I pay too much for a stock? Or what if I lose money in an investment? Or what if I miss out on a great investing opportunity? Well, for that, I have 3 basic rules to help ease these investing fears. And if we follow these rules whenever we're looking to get involved in a new investment, well, we'll be far more likely to at least control our investing fears and ultimately allow us or empower us to live the financially independent lifestyle we all want and deserve. Okay, let's start with the first investing rule, and this one focuses on finding the right company and coming up with a fair value of the stock. So, our first rule is to keep it simple. Now, this may sound easy and somewhat of a generic investing rule, but I have found that it takes a fair amount of discipline to keep things simple. Now, I think this is particularly true when we're picking a stock or trying to come up with a fair value of a stock, because oftentimes as we do our research and we learn more about a particular company, well, we want to include every new piece of information that we uncover about that company, and we want that to impact our belief of how fast a company might grow, or how successful an acquisition might be, or ultimately how good the company really is that we're analyzing. So just focusing on picking the right stock for a second, as we read about the company by going through maybe their annual report or through their investor presentations or things like that, well, during that process, or by the end of that process, really, we should ask ourselves, we should decide if we like the company based on whether or not we can explain simply why we like the company. If we can define and if we can simply explain what we like about this business over the long run or over our intended investment horizon, so if we plan on holding it forever or for a few years, whatever it is, can we explain simply in, let's say, under 2 minutes why we like it and what we need for it to happen with this stock for this to be a good investment? If we can do that, then that essentially becomes our investment thesis. And by keeping it simple, we can help drown out some of the noise that might come with this investment. And this keep it simple rule also meshes well with the second rule when we're trying to come up with the fair value of the stock and where we buy the stock, or getting over the fear of not knowing when to buy that or at what price to buy it at. So for that, rule number 2 is to create our own baseline rules for when we enter a stock. So personally, when I try to value a stock, I like to use discounted cash flow. That's generally my favorite version. Basically, that's when discounted cash flow is when we project how much free cash flow a company will earn over the next few years, and then we try to determine what that's expected to be worth today. Then in theory, we want to buy the stock for less than that calculation of fair value. Now, I did a whole video on when to buy a stock, but for the sake of this video, it's important that we set our baseline rule for ourselves. And we want that rule to be simple enough that maybe we could write that rule down on an index card as to why we're investing in the stock and at why we're investing at this particular price. For example, maybe I like Apple stock, and I did a video on how to do discounted cash flow, and it was like a step-by-step guide on doing discounted cash flow. And in that video, we came up with a fair value. I used Apple as the example, and that calculation said that the fair value of the stock was $219 per share. Well, I'm fairly confident in that analysis, and my personal baseline rule is that if I'm fairly confident in my analysis, in my calculation of fair value, I want a 20% margin of safety, which means that I won't buy Apple stock unless it falls 20% below my calculation of fair value. So I take the $219 per share and I multiply that by 0.8. 0.8 comes from, if you take the 1, which represents 100%, subtract the 20% that I require in order to get involved, multiply the 0.8, so that's really 80%. 80% of 219 means that I can't enter Apple stock unless it falls below $175 per share. Now, here's the best part when it comes to answering questions like, what if the stock market crashes? Or what if I lose money? Or what if I miss out on a great investment opportunity? Well, now, by keeping our process simple and defining our baseline rules, well, now we can just lean on those rules. We can essentially blame the rules for when we either get in or don't get into a stock. So if Apple never falls below the 175 and we don't buy it, well, we didn't really miss the opportunity. Our opportunity, even if it goes to $300 a share, we weren't going to buy. We have a rule. We're not going to buy unless it falls below, in this case, 175. Now, if it does fall below the 175 and we jump in, what if it keeps falling? What if the stock market's in the middle of crashing and we jump in and buy it and it keeps falling? Well, this is the key to this whole rule working. If we know why we invested, then all we have to do is to continue to challenge our why we're investing in this stock. So we take our simple investment thesis and we say, has anything fundamentally changed about why we want to invest in this stock? So if the stock, we bought it at 175 and it continued to crash, maybe it's down to 150, 125. Well, fine. Maybe we can jump in and buy more. If the fundamentals of what we like about the company hasn't changed, then perhaps this is a bigger opportunity to buy more of the stock. So maybe we invested in Apple because we believe that Apple has a strong brand and they have a very loyal customer base, and that loyal customer base is willing to pay a premium for a very good product. If that hasn't changed, then I'm guessing that the current loss that we're experiencing is just temporary. Okay, so that's rule 1 and 2, where we want to keep it simple and we would want to define our own baseline set of rules as to when we buy the stock. Now, rule 3 looks to tackle the fear of, well, how do I know that I have the right stock price at all? In our Apple example, well, my calculation of the fair value was $219. How can we be reasonably confident that that is a fair valuation? And for that, our third rule is to start with the group, or basically to start with consensus estimates when we're trying to come up with our fair value of a stock. So anyone who's seen any videos that we've done, any company analysis videos where we use discounted cash flow, may know that I like to use consensus estimates for what expected free cash flow is going to be going out the next couple of years. So starting with consensus estimates is what I mean by starting with the group. Right now, as an example, on Yahoo Finance, Apple has 40 analysts that are estimating what 2019 earnings per share will be, and 41 analysts estimating what revenue should be over the next year or two. Well, we can use these projections as a starting point for our own projections. Now, I'm not suggesting that we need to stop here, but we all know that analysts can be wrong. But if we start there and then we adjust their estimates based on the research that we do. So we start with theirs, we say, I see why they're doing it, but I think it's going to be a little better or a little bit worse, or I'm a little bit more conservative. What if it doesn't work out that well? Well, we can adjust those numbers accordingly. This is a lot better way of doing it than trying to model out the entire business to come up with revenue estimates or profit estimates or even free cash flow estimates. Now, I learned this a few years ago. I went to an analyst training course that was put on by the director of training for Morgan Stanley's global research team. And he once said to me something along the lines of, the more complicated that our valuation method is, the more likely that something will go wrong. Warren Buffett said something similar to this about when he was talking about valuing a stock in one of his shareholder letters, where he said, I would rather be vaguely right than precisely wrong. So in my mind, all of this points towards keeping the why we buy a stock very simple, and the when we buy the stock very simple by following our predetermined set of rules. And then we start with consensus estimates and only make adjustments to consensus as necessary. This should really help our job much easier when it comes to what stock do we buy, where do we buy it? Because at the end of the day, our job is to find great investments and help each of us achieve our own financial independence. So if you find yourself getting stuck on coming up with the fair value of a stock, well, like I said, personally, I prefer using the discounted cash flow technique. And I've got a link below, and a box should pop up towards the end of the video that will send you over to the discounted cash flow video. I think that's a good place to go to. But if you prefer to focus more on the margin of safety side of things, well, then head over to a video where we talk about when to buy a stock. And that should be the next video you watch if you're unsure, if you're a bit nervous about when to jump in and actually buy it. But the key to this whole thing for all of us is to recognize that any estimates of fair value are just that. They're estimates that we came up with. Even in the Apple example where I used 219. Maybe Apple's not really worth 219. Maybe it's worth 210. Maybe it's worth 230. That's why we add a margin of safety to this whole thing, because if it's worth 210 or 230 or 219, if we buy it at 175, I'm fairly confident we're going to do okay over the long run. Now, I do think it makes sense for us to continue to watch each of our companies and continue to challenge our investment thesis. But if we adopt these 3 rules, I think this will go a long way towards easing some of our investment fears and help us achieve the financial independence that is the purpose of investing. So, thank you very much for sticking with me all the way into the video. I really appreciate it, and I'll see you in the next video. Thanks.